So just give me one more second because it's connecting to Facebook Live. Yeah, yeah. Otherwise, I will be repeating the same thing. Okay, sorry about that. Yeah. Okay. I'll just thank you for tuning into this webinar. The webinar itself, right? Actually is going to talk about gold ETF because Bursa Malaysia is going to launch the gold ETF soon. So this seminar indeed is to get you excited about the product itself, and hopefully when the gold ETF is launched in near future, you will know what to do about it. Okay, because it's sincerely one of the good instruments to whether to hedge your position or whether to participate into the price movement itself. Okay, the internet is a bit slow. It's still connecting to Facebook Live. Okay, never mind. I'll just get started with. Okay, just a normal disclaimer here at the moment. Okay, the seminar is presented to you for education purpose only and for sharing purpose. Okay, so if you base on any one of the slides and do tradings and you make money out of it, right? Do not come treat me coffee. Okay, but if you lose money based on it, right? Also do not come after me. Okay, this is the purpose of disclaimer. So basically, I'm also an SGA Academy speaker as well. So I constantly giving out a lot of market commentary, be it on the TV, on the radio, on newspaper as well. So this is me on the SGS Academy website, being speaker there. And this is me on July 15, one of the largest event I have this year, 650 crowd fools in Singapore. Okay, and this is me on Channel Asia and this is me on Channel 8 as well. Okay, so today course content, right, is all about building wealth with gold exchange traded fund. First of all, a brief introduction on what is ETF and basically, right, type of ETF listed in Bursa Malaysia as well. And okay, some brief history of gold and the difference between different gold investing instruments and the gold macro outlook as well. Okay, so exchange traded fund, like I say, right, it's one of the hottest product at the moment. Okay, to sum it up for you, right, exchange traded fund is just like unit trust, or you can call it a mutual fund, or some may only know it by the name of public mutual. It's just a mutual fund, right, listed on the stock exchange that you can trade from 9 to 5 p.m. during the trading hours. Okay, mutual fund itself, right, basically, you can see that what is mutual fund exactly? Mutual fund basically is a pool of funds set up by a fund manager, and they also set up a fund mandate. So the fund mandate can be, I want to invest into the all the oil companies in the world, or he wants to invest into the high dividend yield stocks in the world. So if you believe into that mandate, right, you just put your money inside to it. So what the fund manager will do is that it will gather all the funds, right, and basically you will put it into investment across different regions. So by investing into different regions, right, basically you are diversifying your risk as well. So when you talk about mutual fund, normally we know the concept of diversification into different regions, diversification of risk. However, for stock itself, right, if you invest into Maybank, so you're exposed into a single stocks risk. We call it concentration risk. But against, right, stock allows you to trade during the day itself from 9 to 5 p.m., right? As long as there's willing buyer or willing seller, then you can get your trade done immediately. Mutual fund, nevertheless, right, is trade a bit differently. First of all, you need to have money inside the bank accounts. Then you need to call up your agents. Sorry, just 1 second now. Okay, so mutual fund itself, right, basically is okay. So when you call up your agent to do a trade itself, right, basically the agent will tell you that the cutoff time will be maybe 12 p.m. or 1 p.m. Okay, so and then you also need to ask your agents, okay, if I want to make a trade now, right, what is the price that I'll be getting at? Your agent may actually tell you that, okay, I cannot tell you what price exactly you'll be getting at now, but I can tell you yesterday indicative price would be $1. So today, if you buy into it, right, you supposedly will be getting it at maybe around $1 per se. Sorry. Okay, so basically, sorry, it keep popping up the chat box. Okay, so basically, when can you know what is the price that you'll be getting at? Only on the next working day, on T+1 trading day. So the agent will only tell you the next working day, right, on what is the price you'll be getting at and how many units you'll be getting at. Okay, but however, for exchange traded fund itself, right, has the best of both worlds. You have the diversifications, and you also is listed on the stock exchange, right, that you can trade during the trading hours. Okay, exchange traded fund is also an open-ended fund. Okay, unlike unit trust, it's a closed-ended fund. When you set up the fund size of $2 million, right, you can only reach a AUM, asset under management, of 2 million. Exchange traded fund is open-ended, meaning to say that it can go to indefinite number size of the fund size, which is it can be 1 million, 2 million, 3 billion, 4 billion also can. Okay, and you also try to aim to track the performance of an index and provide you access to multi-asset classes as well. When we talk about track the performance of an index, right, you can think about KLCI index. So when KLCI index, right, go up by 1%, you expect the ETF also go up by 1% as well. Okay, and the main idea of the exchange traded fund is also passive investment. Unlike unit trust is active management, right? Whereas unit trust is a discretionary fund, actively managed by the fund manager that you want to go in and out frequently to select the stocks in order to beat the markets. Exchange traded fund doesn't do it that way. On the beginning of setting up the fund, right, it will tell you exactly what stocks it will invest into. Okay, for example, for KLCI index, it will invest into 30 stocks. So for this, so your prices, ETF prices movement, right, will be based on these 30 stocks and on the market cap, on the market weightage itself. Okay, so it call it passive management. However, for unit trust itself, right, it will not tell you exactly what stock you'll be investing into. It basically will just tell you the top 5 holdings or the top 10 holdings, and you can see it on the monthly fact sheet itself or the quarterly fact sheet. Have you ever wondered why unit trust does not tell you all the holding that he has been holding? The reason is because if you know what is buying at the moment, right, you just buy into it. Then you do not need to buy the unit trust anymore. So normally they want to hide their holdings because they are going to charge you a premium price, a higher management fees, right? Because they believe that you believe into their expertise that they can beat the markets. And at this moment, right, exchange traded fund is available for all investors. As long as you have been trading stocks, you can start trading with your exchange traded fund. Okay. And Mr. Najib, during the budget statements, right, you also say that warrant and ETF is exempted for stamp duty. So basically, our government actually encourage you to trade into exchange traded funds. When we talk about stamp duty, right, you need to pay $1 for every 1,000 ringgit Malaysia. Okay, and at this moment, right, it's exempted. Okay, exchange traded fund is quite popular at the moment, and according to PwC, right, you expect the growth size, right, in total AUM, right, will surpass 7 trillion in 2021. Okay, if you look at the history of the fund size of the exchange traded funds, right, it takes 19 years to reach 1 trillion in 2009. And to reach another 1 trillion mark, right, it takes another 3.5 years. And at this moment, right, in 2017, it only takes 1 year to reach 4 trillions. So basically, it's so popular at the moment. Okay, Warren Buffett, right, also like exchange traded fund. He actually say in February that investors should just stick with index fund. And he advised to the investor at the moment, right, you can actually put 9% of your funds into a very low cost S&P 500 index fund, which is ETF, and he suggests Vanguard S&P 500 ETF. Okay, Warren Buffett so believe into this exchange traded funds, right, and into especially the S&P 500 performance. He even made a betting 10 years ago, saying that back in 2008, right, he said that for the next 10 years, S&P 500 price performance, right, is going to outperform any actively managed fund. Okay, so the betting amount is 1 million. So Protege Partners, active management companies, right, actually took out the bet, saying that he will select 5 of his funds and claim that after 10 years, right, the average performance of these 5 funds, right, will outperform the S&P 500. So now is 2017, 9 years into betting. You can see that the annualized return of S&P 500, right, is 7.1% per annum. Whereas Protege Partner, this 5 funds average performance, right, is just 2.2%. It means that 9 years ago, if you put in $1 million, right, you can get a net profit of 854,000 from the S&P 500. Whereas this Protege Partner can only give you a net profit of 220,000. Okay. Bank accounts. So what exactly is index investing? Index investing is basically a compilation of the stocks, right, to track a particular markets. So when we talk about markets, right, we can be Malaysian market, so it can be KLCI index. Or if you want to track the Singapore market performance, right, it can be Straits Times index. US, it can be Dow Jones index, Nasdaq, or S&P 500. Into a particular sectors as well. Like I said earlier, you can invest into all the banking stock in the world, all the oil cultures in the world, or all the high dividend yield stocks in the world, or all the gold mining stocks in the world, or track into a particular commodity prices as well, be it gold, silver, oil as well, be it Brent oil or crude oil, WTI crude oil. Okay, a particular currency like USD, Euro dollar, or bond as well. Okay, and basically it provides you a macro view of the performance of that area. And other than, it basically say that other than look into the single stocks that will affect the prices of the ETF, right, you need to have a more macro view of the performance of their markets. So if you believe into the Malaysian markets economy is going to do well, right, maybe it's an investment idea to invest into KLCI index. Okay, I want you to take 1 minute to look at the index performance for this year up until November 14. And ask yourself, right, KLCI for this year has increased to 5.6%. Okay, is your stock portfolio, right, basically outperform this 5.6%? Like, if you take this as benchmark, the agent will tell you that the cut-off, because if your stock portfolio cannot surpass a 5.6% return this year, right, why not you just consider to put your money into a passive management fund, which is KLCI index. And I can tell you, this year alone, right, a lot of index has been performing quite good. For example, if you look at our neighbor country like Singapore, they're actually going up by 18% this year. US Dow Jones 18%, S&P 500 15%, and Nasdaq 25%, and especially Hang Seng Index 32%. And if you look at some other index performance like gold, 12% increase this year, and crude oil, right, is 5% this year at the moment. Okay, so what exactly is KLCI index? Okay, KLCI index, right, basically composed of 30 largest company by market cap. Okay, if you look at back in 2009, the component stocks, right, things like BJ Toto and MAS and Parsons, right, is no longer inside the component stocks anymore. It has been replaced by maybe Hap Seng, Hong Leong Finance, or KLCI Property REITs, massive counters. Okay, some of the reason why this stock is not included anymore, right, because the KLCI review committee, right, will review the component stocks, right, semi-annually. Okay, basically they review based on market cap and liquidity. When we talk about liquidity, right, basically we need the stock to be actively trading some. Okay, so what is market cap? They want the largest market cap company to be inside the component. Market cap basically trying to say is the share price times the number of share equal to market cap. So as long as your share price keep on increasing, right, your market cap will increase. And in return, right, you want it to put it down. If your share price keep on dropping, you want to remove it. So in another word, it's trying to say that I want to put in all the good stocks, and as long as the stock is not good anymore, drop in prices, right, I want to remove it. Okay, so part of the reason from 2009, our KLCI index going up from 800 points to above 1,700 at the moment, right? It's not solely because our economy is good. Part of the reason is that because there are good stocks keep on adding into the component indices. Okay, and also it brings you to another idea of holding the index ETF as well, which is longevity. Because stocks like MAS, right, can go delisted or go bankrupt, but KLCI index itself, right, can last forever because it will keep on replacing with new good stocks. Okay, so the ETF itself, right, basically, when it go up by KLCI go up by 1%, the KLCI ETF, right, also need to go up by 1% as well. And how the ETF manager track the index? Basically, they use some approaches. First of all, like direct approach. If the KLCI index, right, composed of 30 stocks, then they will just buy into all these 30 stocks. The other approach is called sampling approach. If the top 10 holding represents 70% weightage of the index, then you will just buy into the top 10. The third approach would be synthetic approach. So in the synthetic approach, right, it's a bit complicated. Basically, you just buy into derivative products or the swap agreement. Okay, the idea is basically whatever other party is currently doing it by using other instruments, right? You just use your fund to buy into that instruments. Okay, so in the Malaysia ETF itself, right, usually they use direct approach and sampling approach. Okay, so what is the benefit of indexing? Okay, first of all, passive investing and help you to achieve diversification as well. And there's no expiry date like futures contracts. So if you invest into oil futures or gold futures, right, basically you need to roll over it and to incur rollover fees. But here, right, it will do it for you under ETF structure. And it's very low cost as well. Imagine you want to meet the KLCI index, you need to buy into all the 30 stocks component, correct? So how do you buy it? You need to key in order 30 times and incur 30 times commission. And when you sell it, you need to key in order 30 times and incur 30 times commission as well. However, for ETF itself, right, you just need to key in one order and one order to sell and to incur one-time commission to buy and one-time commission to sell. And it also give you dividend as well. And again, price transparency, it will straight away tell you that what stock it will be investing. $2 million, right? You can only keep. Okay, so against ETF and like unit trust, it gives you diversifications. And the annual management fees, right, for ETF, right, is usually very low, below 1%. Unit trust is usually higher, 1 to 2%. And sales charge itself, right, unit trust will charge you maybe 2 to 5%. Stocks and ETF do not charge you sales charge, but they will charge you commission when you buy and when you sell. Unit trust, when you do the selling, you do not incur any sales charge. You just sell based on NAV. And all these three ETF stocks and unit trust, right, all give you dividend. Okay, so unit trust will not tell you exactly what price you'll be getting at immediately. It will only tell you the next working day. Okay, and stocks and ETF, right, basically you can do contra trading. Usually, and for unit trust, right, you cannot do contra trading. You need to be having the money in your bank account upfront for you to purchase the unit trust. So for the risk of the ETF itself, right, first of all will be the market risk. Okay, like stocks, you are exposed to a particular sectors or market risk as well. And again, foreign exchange risk. Okay, when we talk about foreign exchange risk, right, basically, if you invest into for example, if you invest into S&P 500 ETF, which the denominated currency in USD, you want the USD to appreciate. Because when the USD appreciate and you translate back into your home currency, right, you will get a better return. And again, tracking error as well. ETF, the KLCI index go up by 1%, you want the ETF to go up by 1% as well. But usually there will be some tracking error, maybe due to the commission incur or the annual management fee incur as well. Okay, one of the major concerns that I'll be having will be a liquidity risk, because basically it's depend on the market makers. And if you look at the KLCI ETF spread, you want the spread to be as tight as possible. And you also need the quantity to be as much as possible as well. Okay, so again, right, because it's not that popular in Malaysia, right? So the spread, right, it could be a bit big sometimes when you look into it. And then again, right, the queuing volume or the selling volume, right, is not that good as well. Okay, so some of the ETF that is listed on Bursa Malaysia, right? At this moment, if you look at S&P 5, if you look at US ETF, there is over 1,000 ETF listed in the US. There is about 160 ETF listed in Hong Kong, and there is about 82 ETF listed in Singapore Stock Exchange. But in Bursa Malaysia, right, we just have 8 ETF, okay, at the moment. Okay, so 3 of them belong to equity ETF, and 4 of them belong to equity ETF against but is Sharia compliance, and 1 of them will be our oldest ETF, fixed income ETF, bond ETF. So the popular one will be KLCI ETF. The KLCI ETF, right, the major weightage will be coming from bank stocks, 35%, utility 40%, telecommunication 13%. So it invests into like public bank, the CIMB, Samdabi, Asia as well. Okay, and one of the major things that when you look into Malaysia ETF, right, you not just look into the GDP number, not just look into the stocks, right? Okay, one of the things that you need to look into it would be the currency movement as well, because other than capital appreciation, other than dividend yield, right, what the fund manager want to look at when they invest into your into the index, into your country, right, will be the currency. They want your country currency, right, to appreciate. So usually the currency and KLCI index movement, right, has an inverse relationship. For example, if you look at KLCI back in early days when it was doing at 1896, the currency versus Malaysia ringgit versus USD is 3.15. Then from 3.15, right, actually depreciate to 4.48. And our KLCI index, right, dropped to 1,500. Okay, and when our currency appreciate from 4.48 to 3.9, right, our index go up as well. So at this moment, since the beginning of the year, you can see that our index performance has been going up from 1,600 to about 100 points to 1,700. Our currency actually appreciate from 4.52 to 4.1. Okay, because it's telling you that people are putting in money into your markets. This is why your index has been increasing. But the thing is, why your currency is still appreciating to 4.16, but your index performance, right, dropping from 1796 to 1721 at the moment? Okay, I think no one can give you a set answer why is that so, but I'm trying to give you an answer here, which is I think maybe in the beginning of the year, right, a lot of foreign fund manager, right, already is inside the markets because they want to because they actually anticipate that the general election, right, is going to incur in maybe September or November, but they wait until September and November, right? There's no general election, and now the news is that the general election is maybe in the February or March. So basically, they cannot tahan anymore lah, because other indices markets, right, has been doing quite well. So they rather put their money, right, into other markets like Hong Kong or maybe US, which actually outperform major indices at the moment. Okay, so if you look at Bursa Malaysia, right, it actually give you 2 dividend in a year, and at this moment, right, the dividend yield is about 1.8%. It's not bad. Okay, the second ETF that I'm going to introduce, it will be CIMB ASEAN 40 Malaysia ETF. Basically, it will invest into 40 companies in Singapore, Thailand, Malaysia, Indonesia, and Philippines itself. So the top 10 holdings would be like Singapore stocks, OCBC, DBS, and UOB, and Singtel. 45% of the weightage focus on financial stocks, and 14% focus on telecommunications. And you can see that from the low of 2001, 61.55, right, it actually was doing quite good to 1.945 at the moment. Okay. Okay, and it also gives you dividend as well. At this moment, the dividend yield, right, is about 3.85%. Okay, the third ETF I'm going to talk about will be the A50 ETF. Basically, it's the China company listed on the Hong Kong Stock Exchange. Okay, so the top 10 holding include Tencent. Definitely, you know Tencent. What is Tencent? Tencent would be the WeChat or Wangzhe Longyao in your mobile phone at the moment. And invest into the banking stock as well. So 57% invest into financial stocks, 10% into oil and gas, 10% into telecommunication, 9% into technology stocks. Okay, if you look at the share price performance, right, from 2016, 1.015, it increased by about 60%. It's very good. So the reason why I want you to look at this ETF is that if your KLCI index is not doing well, right, that is one of the way for you to participate into overseas markets, such as China markets, is to invest into the A50 ETF like this. Okay, and one of the reasons, okay, and you can also see that Hang Seng Index has been going up so much, right? So this is one of the major reasons why the index movement go up so much this year. But another reason why it actually go up is because Hong Kong dollar has been appreciating. Okay, so you also need to take a look at Hong Kong dollar currency, because this fund, right, is going to put your money and go and buy into the Hong Kong listed stocks, denominated currency in Hong Kong dollar. And remember, Hong Kong dollar is pegged to USD. When USD appreciate, Hong Kong dollar will also appreciate. So when it translates back to Malaysia ringgit, right, then this price will go up higher. So this A50 ETF, right, is also provide you one way to hedge your Malaysia ringgit currency as well. Okay. So the fourth ETF will be a Sharia compliance ETF Dow Jones 25 index. Okay, this is very similar to KLCI, but it focuses on Sharia compliance stocks. Okay, and 59% focus on trading and services, unlike KLCI index, right, focus on the banking stocks. Okay, and it focus 60% on the industrial products as well. Okay, I'm so sorry that I need to make this as fast as possible because there's a lot of things that I need to cover. Okay, so for this Dow Jones 25 stocks, right, it gives you a dividend yield of 2%, not so bad. And if you look at the prices movement, right, from 2001 6 low of 1.035, now it's about 1.11. Not so bad, not so bad. Okay, and the second Sharia compliance stock would be the Islamic dividend stocks. They are going to invest into the 40 stock listed in Malaysia, and 30% focus on trading and services, industrial products, and infrastructure as well. So you can see some of the good brand name like Tenaga, DG Petronas, Massis, Hatalega as well. Okay, but the thing about this dividend ETF is that you can see that in 2016, the dividend payout is 3 cents, but in 2017, right, it only give out 1.5 cents. So the dividend yield is 1.42% now. Okay, so when they so-called dividend yield stock, but they only give you 1.42%, then you need to think about it, whether this dividend yield, right, is suitable for your stock portfolio or not. Okay, however, the share price performance, right, is not so bad. From 2016 low of 97 cents, now go up to $1.08. Okay, and the next one will be the Sharia compliance stocks again, focus on Southeast Asia markets, Singapore, Malaysia, Indonesia, and Thailand. So you can see some brand name like telecommunications in Indonesia, SIA in Singapore, SPH in Singapore as well. But the thing about the stock is that it focuses on industrial, consumer discretionary, and telecommunications. So the dividend yield is actually 2.37% at the moment. And basically, a lot of consumer stocks like SPH and SIA or ComfortDelGro, right, is not doing so well. So the share price has been dragged down because of that. So from 2016 low, 85 cents, now it's only doing at 90 cents per se. Okay, and the next one I'm going to talk about will be agriculture ETF itself. Okay, agriculture ETF, right, is a good concept. Okay, it basically buying into 30 largest stocks listed in the Asia Pacific, and it only buy into the upstream counters. Okay, it don't buy into the downstream counter, it only buy into upstream counters. So you can see some good brand name like Otogi, sorry, 1 second. Okay, the Otogi, KLK, PBB. You can see it invests into South Korea market, Malaysia, Hong Kong market, New Zealand market, Hong Kong market, Taiwan market as well. So 29% is into food processing, 44% fishing and farming, and 20% agriculture business. Okay, basically the idea is very good because you need to think about it. Oil could be replaced by renewable energy, correct? Gold is not a necessity, but agriculture, right, is an edible things that cannot be replaced. So if you like this kind of concept, right, the share price is actually doing quite well at the moment. From 2001, $6 or 91 cents, right, now it's doing at 1.07. Okay, the last one will be our oldest ETF, which is a bond ETF. It's basically invest in all the Malaysia government bond. 95% is the Malaysia sovereign bonds, and it aims to give you a 3.87% coupon rate payments. Okay, but the thing is that, okay, so you can see that from 2001, $6, $1.055, now increased to 1.13 ringgit Malaysia. Okay, so the idea here is that we call it bond ETF. So basically, you want it to give you some coupon payment, right, as a dividend payout. But the thing is, this bond ETF, right, stopped paying you dividend starting in 2001-06. So the last dividend payout is in 2001-05. 2001-06, it didn't give you dividend. 2001-07, it also didn't give you dividend as well. Why is that so? Okay, I cannot answer for you. Basically, I actually sent them an email to ask them about it, but they did not get back to me. So I cannot answer to you why. But you need to think about it. Okay, if you invest into this bond ETF, right, it does not give you dividend. Can you be satisfied by the price performance? Okay, this is the thing you got to think about. Okay, next I'm going to talk about gold ETF. So what is gold ETF? Gold ETF is basically precious metal. Okay, and gold is precious metal alongside with silver, platinum, and palladium as well. So firstly, precious metal are known to be shiny and attractive. It's nothing special since most metal shine as well. So, but precious metal are kind of different in the way that they're also known by their longevity. It means that the metals, right, are generally non-reactive. Unlike metals such as iron, right, which will become rusty over time, right? Take gold for example. If you own a gold bar, you believe that you will know for certain that 10 years or 20 years down the road, right, the gold bar will be still the same gold bar. So, and lastly, the metals are very rare. We call it finite asset. Meaning to say, right, there's limited supply to each of these precious metal in the world. Together, it makes people want to store them because their value can be preserved for quite a long period of time. But what is so special about gold compared to other type of precious metal? So I think the answer can be as simple as this, because when you see all the picture of these precious metals, right, it's easier for us to identify which one is gold, but it's very difficult for us to identify which one is silver, which one is platinum. Because gold looks significantly different from the rest of the precious metal in terms of the color and in terms of brightness. And I think this is how gold become so popular in the human society. And as a Chinese myself, right, the cultural things also tell me that from young age, you need to like the color of gold as well because of the brightness. And then it's kind of a common thing for us to want to store the gold at your home. Okay, you won't hear someone telling you that, oh, okay, I actually got a tons of oil, right, storing in my garage, or you can't remember anyone saying that I actually store silver or platinum, right, in my car garage or my safe deposit box, right? It sounds quite absurd to you. But if you tell people that, oh, I got the a bar gold, right, in my safe deposit box. So the whole concept sounds cool. So this is the one of the cultural things. So therefore, there is no surprise that gold was worth a lot of money in the ancient civilizations. And if you look at the gold performance this year, right, it basically go up more than 10%. Silver 4%, platinum actually dropped by 1%. Palladium actually go up by 41%. But today we focus on gold itself because gold is quite a liquid. It offer you more liquidity. And if you look at history of gold, right, basically the first civilization to use gold and silver, right, as a currency was in ancient Rome, where coins are issued for every fixed amount of gold given to the government. By 1800, right, most countries in the world had printed currency supported by their value of in gold. So this is called the gold standard. Okay, so it basically means that your currency need to back by gold. So under the gold standard, right, every currency is fixed to gold as well. Okay, if you don't mind, right, let me sidetrack a bit to talk about cryptocurrency. So the idea about cryptocurrency is like Bitcoin, right, is similar to the idea of gold standard. Gold standard, which you have a gold, you have a finite asset. Bitcoin also got a finite asset as well. So you kind of believe that it will increase in value in time because it's finite. But fast forward to today's world, right? We all know that our currency is not backed by gold anymore. So the entire idea of cryptocurrency being the worldwide standardized currency, right, it simply doesn't work. And the idea sounds absurd. So what I'm trying to say is that cryptocurrency will not increase in prices forever. Okay, mark my word for that. Okay, so and the problem with a finite asset is the economy is not finite. If you have a limited amount of money to match this unlimited capacity of people in the economy to do this kind of economy things, right, cryptocurrency doesn't work. So to summarize, right, Bitcoin does not allow the economic activity to take place on the scale that we want it to be. Okay. Okay, so we back to the gold standards system. Okay, the gold standard systems, right, was actually used up until 1944. Okay, after the World War II actually ended, when most country they actually recognized a need to establish the proper monetary system. So this is when the Bretton Woods Agreement, right, was introduced to the world. Okay, under the agreements, right, the dollar is pegged to gold, and every currency is pegged to USD. Okay, and it means that every currency, right, is allowed to float against USD, and the value is pegged to the dollar value, right, is pegged to the value of gold at $35 per ounce. Okay, it means that if other currency in order to print money at the moment, right, their currency will depreciate against USD. So the system itself, the Bretton Woods Agreement system, is successful back in the old days because US, right, actually have 75% of the gold at the point of time. So and it also helped establish the standard for gold to be a commonly denominated in US dollar today. And as part of the Bretton Woods agreements, right, IMF and World Bank was established as well. Okay, so however, in 1972, right, basically the US actually realized the dollar value becoming too overvalued. Okay, so because US want to print money, right, to expand their economy, but were held back by the idea of Bretton Woods Agreement as they are unable to back up their dollar notes, right, with the gold reserve. So President Richard Nixon, right, decided to abandon the Bretton Woods Agreement to increase the cash flowing into the economy. So basically what it's trying to tell you is that in order to print more money, US need to abandon the Bretton Woods Agreement. And as more US dollar is pumped into US economy, the US dollar started to depreciate against gold as well. Okay, and most currencies, okay, and basically you also need to understand the idea as well. So at this moment, right, US print more money, and their currency started to depreciate. And all the other countries like maybe Malaysia or China, right, are holding US dollar as their reserve currency. So basically, you can see that the US dollar in your reserve, right, started to depreciate. What will you do? So in that case, right, Malaysia or China's, right, they don't want to have gold and don't want to have USD anymore. So they, in returns, right, they want to have gold in a sense. So this is why you will have a concept of gold is usually used as a hedge against the US currency price movement. So against why you want to invest in gold. As I have mentioned previously, right, gold is a good hedge against currency movement, especially against US dollars. Okay, and if you look at the year-to-date performance of the gold prices, right, in blue color line, you can see that it go up by more than 10% this year. However, if you look at US dollar index, it dropped by 8%. Okay, so if you put your money into gold in the beginning of the year, and at this moment, if you translate it back into your home currency, right, you should have a net return of 2%. Okay. And basically, it also tell you that if you put your portfolio, put your money into gold itself, right, your portfolio movement will be less volatile. Okay, compared to you just invest into your US dollar. Okay, so this is the main idea that you can hedge your volatility and hedge your currency as well. Okay, and the next thing I want to talk about would be diversification into commodity markets. Because in your portfolio itself, right, other than holding equity, you're exposed to equity risk, right? Sometimes it's also best that you have some commodity in your portfolio as well, such as oil and gas or gold. Okay. And okay, so next we are going to talk about the demand of gold. We first need to understand the demand of gold. As you can see from the gold demand in the second quarter 2017, right? The global demand for gold can be attributed to 5 main sources: jewelry, technology, bullion. Bullion, which is you have your gold bar and coins, which is minted by the banks, and ETF as well as central banks as well. Okay, jewelry normally roughly make up to 50% of the global demand for gold. So demand originated mainly from China and India, where gold jewelry, right, is still viewed as a sign of prosperity and are often used as heirloom or gifts. And secondly, right, gold is also used in the technology field as well. In certain medicine, computer like your PC computer, your motherboard, some of the component is made up by gold, and electronics products as well. Okay, however, they are used in a very limited amount for certain essential parts, but still this sector make up to loosely about 10% of the market demand. And bullion itself, right, is held as a minted gold bar and coins by investor and bank, and this make up to 25% of the global demand. ETF itself, right, make up to about 6% of the global demand, and usually ETF, right, is investing into physical gold as well. Okay, and for central banks like US Central Bank or Malaysia or China Central Banks, right, they make up to the remaining 10% of the global gold demand. So for these all 3 demands, right, we need to understand that gold are held by these 3 parties, which are all minted. So it's unlikely for the gold to fall out of the market as their value has already been globally recognized. So therefore, in most cases, right, there will only be inflow of the gold to be minted and recognized compared to the outflow, where minted gold, right, are used for other purpose. Okay, so we know that gold is a limited resources, right? There are finite amount of gold in the world. So how do we fulfill this demand itself? So as of today, right, my production, right, contribute to 75% of the gold supply. However, annual demand for gold, right, usually is higher than the production of level of the gold. So the shortfall itself, right, is actually made up by the gold recycling. So out of the recycling gold, right, 90% come from jewelry and 10% come from the scrap gold from the technology products. And gold bullion, right, is not recycled. So the entire idea is that because you have a finite asset, limited asset of the gold, so basically the demand, right, because usually they will be minted, so the demand, right, usually would outspace the supply of gold. So this is the idea of usually in long term, gold should go up in prices itself. So how to invest into gold? Okay, first of all, you can invest into gold mining company. Secondly, you can invest into jewelry. Or third, you can go to the bank and buy the gold bar. Fourth, you can go into a CFD, buy into CFD products, derivative products, or future products. And fifth, you can go buy into the ETF, exchange traded funds. Okay, let me raise a question here. Out of these 5 products, right, which one will give you the most appreciation in prices if the gold prices go up? Imagine the gold prices increase by 10% tonight. Which one will give you the largest return? Okay, have you ever thought about it? Okay, I can certainly tell you that it will not be ETF, it will not be your derivative product, certainly it won't be jewelry or gold bars. It will be the gold mining companies. Because if the gold mining companies, right, during the exploration, they dig out gold, right, you can see that there will be maybe 30% or 50% price surge in the company share price itself. So in terms of appreciations, right, I would say that gold mining companies, right, will appreciate the fastest. Okay. So let's talk about gold mining company. When we invest into gold mining companies, right, they are actually providing 75% supply to the market. So their share price, right, will react directly to the gold prices changes. So, and furthermore, right, gold mining companies can undertake exploration or acquisition to acquire more gold mine. And this can also lead to an immediate spike in their valuation as well. Okay. So, and secondly, you can also invest in the gold jewelry as well. When you buy into the gold jewelry, sorry, just 1 second. Okay, if you buy into a gold jewelry, right, you are paying a premium to the craftsmanship, correct? And usually when you are selling this jewelry back to the goldsmith, right, you will incur maybe 20% discount to the gold prices. And the premium, the price that you are paying to the craftsmanship, right, they will not value, correct, when you try to sell it. So this is why jewelry, right, is not a good things to actually hold for long term per se. Okay, and the third way to invest into gold, right, is to invest into the bullion such as gold bar and coins as well. So the method is more ideal for value preservation as your bullion, right, is guaranteed by a counterparty like a central bank or banks itself. However, as gold prices are fairly high, if you only invest into a small amount of the bullion, the storage cost, right, can be quite high as well. And imagine if you have gold bar in your house, it could be very dangerous as well, correct? Okay, and just to give you one of the example on how to invest into gold. Okay, you can actually buy in with the bank. Okay, when you buy into the bank, right, basically when you buy it, you are buying into a paper certificate, proof that you have this gold. And when you withdraw, right, you can actually withdraw it into a physical gold, but they are going to charge you. Okay, you will incur a fees, and you may incur an annual service fee as well, and you may incur the gold deposit account fees. Okay, but this is the fee is quite minor, but the major things that I want to talk about is that if you look at 20th of September back in 2017, right, the price difference is going to, if you buy and sell immediately, the price difference is $5.6. So you will incur a 3.12% loss, correct, in the spread itself. Okay, and this is the first disadvantage. The second disadvantage is that it's quoted in Ringgit Malaysia. So when you buy, you need to have Ringgit Malaysia to buy it. You cannot use your existing USD to buy. And when you sell, right, it will go back in Ringgit Malaysia into your account as well. Okay. And if you look at the buy and sell spread difference, right, on 15 November, is only $5.2, but it's still 2.9%. For me, the spread, right, is not that tight. Okay, so this is the disadvantage. Okay, and you buy, the fourth way is to buy into derivative products. Okay, derivative products like futures or contract for difference, which going to have a leverage factors, right? And one of the main benefit is that the market liquidity is quite huge. For example, ETF, gold ETF, right, can only be translated maybe 2.4 million ounces of gold on a daily basis. Gold future ETF, right, on a daily basis, right, translated 20 million ounces. Okay, so the market liquidity is there. However, you need to worry about two things. First of all, the expiration of the contract month. If you buy into gold futures in November, right, at the end of the November, you need to roll over and you will incur rollover fees. Second of all, right, they are buying into gold futures, which is an expectation of the price that is going to end at the end of the contract month. Okay, it's not buying into spot prices. So if spot price for gold increased by 1% tonight, right, the future prices can go up more than 1% or can go up less than 1%. It can be negative as well because futures derivative products trade on market expectation. Okay. Whereas gold ETF itself, right, when the gold physical gold bar increased by 1% prices, gold ETF should also increase by 1% as well. Okay, but gold ETF, right, they normally do, even though the gold ETF invests into the gold bar itself, right, it doesn't mean that you can withdraw it out in gold. Okay, they do not usually give you that kind of options. They basically only want you to design to track, the ETF is actually designed to track the price of gold, and basically you are just participating into the appreciation of the share prices. Meaning to say you want to buy low and sell high later. So this is why they call it paper gold. You cannot withdraw it in a physical gold bar format. Okay, so basically you can think of this way is that you are buying shares, okay, in the stock exchange. And it also gives you the flexibility, okay, to choose whether you want to buy into physical gold bar or you want to just invest into the gold mining stocks in the world as well. And usually the access fees, right, will be quite cheap. Okay, and then we also take a look at the top 5 gold bullion ETF in a glance. Okay, these are some of the most popular gold bullion ETF, and Bursa Malaysia is going to launch one gold ETF listed in Bursa Malaysia very soon. Okay, and at this moment, right, how can you differentiate? How can you tell yourself which one is the best to invest in? Okay, so first of all, you need to look at the average volume, and second of all, you need to look at the AUM as well. Okay, and third of all, you need to look at the year-to-date returns, whether it actually track closely to the gold prices movement. So it also, all of them, right, the tracking error is quite minimal, all also increased by about 10%. Okay, and the next thing that you need to worry about the expense ratio. How much it's going to cost you for holding the gold for 1 year. So this is the most important thing that you need to worry about. Okay, next, let's look at the global macro outlook for gold. At this moment, if you look at third quarter 2017, right, the total gold demand is only 915, but the total gold supply is 1146. So basically what they're trying to tell you here is that in short term, there is more supply than the gold demand. So the gold prices may start to drop. And if you look at the gold demand at the moment, right, it's the lowest since third quarter 2001. Okay, now it's quite low at the moment in terms of gold demand. So basically, since the demand and supply, the demand is low, gold are supposed to come down first. What is the major driver to push the gold prices higher? Okay, first of all, I would say it would be the geopolitical risk. So as long as Saudi Arabia got some geopolitical tensions and push up the oil prices, right, it will in return, right, maybe push up the gold prices as well. Or you can see that in September, October, you can our gold prices has increased. Is maybe because of the geopolitical risk of the North Korea. They are worried about North Korea war. Okay, and USD, you also need to take a look of it as well. If USD keep on appreciating, gold prices should come down. Okay, if US dollar keep on dropping, gold prices should come up. Normally they have this inverse relationship. Okay, so this is why when gold was doing at 1,366 back in 2016 and it dropped to 1,128, right? US dollar actually appreciating from $93 to $103. And you can see that at this moment, right, US dollars start to appreciate again. And this is why the gold prices, right, has been coming off from the top, from 1,300 plus to 1,289 at the moment. Okay, but all in all, I also like to say that we are still in a low interest environment. Mean to say there's a lot of hot money floating around the world. So as long as there's still hot money, right, they are going to chase again, chase the asset prices. This is why the hot money is now in the equity. They're chasing up the Hang Seng Index, chasing up the S&P 500. S&P 500 is doing day high maybe every day at the moment. So basically, right, the hot money will one day when the asset prices valuation is too high, right, they will come to gold and buy up these commodity prices. So I think this is why oil prices has been shooting up recently, and maybe gold, right, in mid to long term, right, it will also go up as well. Okay, let me try to explain it in a technical chart as well. Okay, I actually use a Fibonacci extension, right, to try to find out what is the major support and major resistance level. So I extend this 100% by 127%. Okay, so I can see that the first resistance is 1,302, and then you can see it's quite true because there is some correction from here to here. Okay, and next it go up to 161.8% and do a set touch, and then it come down and back to 100%. So what I'm trying to say here is that the major support and major resistance at the moment, right, would be 1,264 and 1,302, and now we are doing in between. Yesterday closing is about 1,292 if I'm not mistaken. Okay, so we are expecting that it will hovering around this price level. If it drop below this level, right, 1,264, right, it may only find a major support at $1,209. If it continue to go up, shoot up above the $1,300 mark, I would say that the next major resistance would be $1,351. Okay, so this is my take on the gold prices movement at the moment. So I think it's doing sideways at the moment, but over here, right, would be one of the prices that you can maybe establish some long-term buying investment opportunities. Okay, so next, okay, we now move to the Q&A sessions. So if you have any questions at all, right, you just put it on the chat box and I'll try to answer one by one. Okay. Okay, so let me go up and look at it. What is our loans? Okay, I can see that I have one question here saying that there is one particular ETF, right? It's actually tracking the telecommunication stocks and banking stocks at the moment. So what is the outlook for these two sectors at the moment? Okay, first of all, I believe you are talking about Okay, first of all, I believe you are talking about one of the particular ETF that is invest mostly into the banking stock, which is CIE ETF. Just a second. Let me move to the ETF. Just 1 second. Okay. Okay, you can see for this ETF itself, right, actually invest into 45% into different region banking stocks at the moment. Okay, all I want to say is that it's not a easy answer to you, but to put in the long-term basis, right, you can see that US will keep on increasing the interest rate. As long as they want to increase the interest rate, right, this should significantly improve the net interest margin of the bank itself, be it Malaysia Bank or be it Singapore Bank. Because Malaysia LIBOR rate is going to increase because US increase their rate, right? And Singapore SIBOR rate is going to increase as well. So this is why all the earnings for all these three banks listed in Singapore at the moment, right, are doing quite good at the moment. Okay, and let me sidetrack a bit and to tell you one major things. Basically, I believe that Donald Trump, right, need to increase the interest rate as fast as possible, and he wants to do that as well. I give you two reasons why. First of all, the economy data is still doing good at the moment. So he wants to increase the interest rate when the economy is good. If the economy is not good, right, he increase the interest rate, then the share prices will drop. You don't want to face that kind of scenario. Second of all, right, the purpose of increasing the interest rate is that if you don't push it up first, you cannot push it down later. Okay, let me explain it why. You can see that for the US Fed fund rate at the moment is 1 to 1.25%, correct? If there is a market crash scenario happening in US at the moment, how low can you push it down? You can only maybe have a rate cut of 4 to 5 times and push it down to 0%. Because you have to understand that in terms of market crash, right, one of the most significant strategy of the central bank is to just cut the interest rate, which is the monetary policy. Okay, so this is why Donald Trump want to increase the rate as soon as possible, because he actually expect a market crash scenario maybe happening in 2019 or 2020. So his strategy is pushing up the rate in 2017, 2018. If 2019 and 2020, right, have a market crash, then it drop the rate. You push it up first so that it can drop it down later. And if it do so, right, market will cheers. Because the stock market, when there's market correction, right, you cutting the interest rate, you push the market back up. And then people will elect him for another 4 years. So this is his purpose. He want to be in terms for 8 years in total. Okay, so come back to the banking stock at the moment, right? Another thing that you also need to understand is that US basically at this moment, right, is campaigning to dismantle the Dodd-Frank Act. Okay, so because of this, right, US banking stock has pushed up more than 20% at the moment. Okay, do you know what is Dodd-Frank Act, by the way? Dodd-Frank Act is basically the capital requirement of a bank, restricting how much you can lend it out. So back in 2008, right, the Dodd-Frank Act, before the Dodd-Frank Act, for example, Citigroup, the leverage ratio is $35. So for every $1 in Citigroup, right, you can lend out $35. And at this moment, right, after the Dodd-Frank Act implemented, at this moment, the leverage ratio is just $10. So for every $1 in the bank, he can only lend out $10. But Donald Trump want to dismantle the Dodd-Frank Act, potentially can bring up the leverage ratio to $13 or $14. So you can not only lend out $10, you can lend out $14 or $13. This will significantly improve your earnings growth. And let me tell you one thing. Powell may be the next federal head, Fed fund head, Fed head, and I think he's going to deregulate deregularize the banking system as well. Okay, so basically, I think banking stock could still have some growing story at the moment, sir. And in terms of telecommunication stocks in the world at the moment, right, I think they are facing steep competitions at the moment. And if they want to adopt the 5G system, they are going to incur a huge startup cost as well. So my outlook for telecommunication stocks at the moment is not so good. Okay, let's come to the next question. Okay, if no or low, okay, I have a question here saying that if there is low or no volume for local ETF, then how to sell? Okay, first of all, right, the market maker try to ensure fair pricing. So as long as the quoting price that you are giving in the market, quoting in the markets, right, is fair, market maker will always try to match you. Okay, because they also want to ensure liquidity in the markets. They need to participate 70%. They will need to put in order at least 70% of the trading hours during the day tradings. Okay, and if your volume is so high, maybe you got 500,000 shares or 1 million shares, right, that you want to sell, right? You don't sell it in the markets. You call up the participating dealer and say that, okay, I got 500,000 shares want to sell, 1 million shares want to sell at the moment. Can you give me a better price? So basically, they will look at their INAV at that point of time, right, and quote you a better price to sell for you to match your order. Okay, so this is how you sell. But again, right, what I want to say here is that as long as your quoting price is fair, usually market maker will try to match you. Okay, and but all I want to say here is that market maker also need your support as well to ensure the liquidity. Okay. Okay. Go mining on. Okay. I have a question here saying that at this moment for gold, right? You should focus on gold mine or gold bullion at the moment. Okay. Basically, the gold ETF listed in Malaysia, right, is going to focus on physical gold. Okay, so you can look into the gold prices at the moment. Gold miners stocks is a very interesting topics. Okay, but Bursa Malaysia is not going to launch it. Okay, but if you are interested, right, you can actually request for an entire session for the gold miner stocks. I'm very interested to talk about it. Okay, okay. Let's talk about the next questions. How much capital should I come out with to trade the gold ETF? Okay, at this moment, right, I only know that the lot size is most probably is going to be 100 shares. Okay, I do not know what is the share price going to quote. Should it quote by $1, right? Then you just take 100 shares times $1 equal to $100. It can be Ringgit Malaysia or it can be USD. I do not know the detail yet. So you can only know it in near futures. But in your case, right, is your question asking how much capital is best to come up to buy into the gold to make out the entire stock portfolio? I would say it actually depends on your entire risk profile as well. Okay. I have a question saying that do you use Fibonacci retracement as well? Yes. Yes. But if I use Fibonacci retracement to look at the gold prices movement, right, I will draw from the 1920 high back in 2009 and draw it to the, I think, $1,000 low and look at the major support and resistance. Okay, because the price now is actually moving up and I want to look at the short-term support level and resistance level, right? So this is why I use an extension level instead of retracement level at the moment. Okay. Okay, I have a next question from Don saying that I do invest in equity markets. My annual return is 12 to 15%. Congratulations. It's very good. Average for the last 3 years. Can I get return more than 15% per annum from gold ETF fund? Okay. And what is the past performance of gold ETF funds in Malaysia? Top 5 gold bullion. Okay, I'll just answer one by one. Okay, there's a lot of questions by Don. Okay, first of all, can I get a return more than 15% per annum from gold ETF funds? It's possible. I would say I do not know, but the answer would be possible. Based on two conditions. You need a lot of hot money to chase gold. You need to have a spike in gold as well. From 1,200 at the moment, you need to go up to 1,300, 1,400, and basically you want the Malaysia ringgit currency, right, to depreciate as much as possible, because you want the because this gold ETF, right, it basically denominated in USD ma. So you want the Malaysian ringgit to depreciate as much as possible. So when it translates into Malaysian ringgit, right, you have the best of the currency appreciations. Okay, so again, I need to throw this question back to you. Other than gold prices movement, right, do you expect the Malaysian ringgit to depreciate some more? If the answer is yes, right, then probably you can see a more than 15% per annum appreciation from the gold funds. And what is the past performance of the ETF gold fund in Malaysia? There is no gold fund listed in Malaysia at the moment, but there is one gold mining company listed in Malaysia, if I'm not mistaken, should be Borneo Oil. Okay, company there. I think they is an exploration company which dig out gold in Pahang, if I'm not mistaken, at the moment. So you can take a look into it and look at the share price performance, but there is no gold fund listed in Malaysia at the moment. So the top 5 gold bullion ETF guns is annual return will be 10% because it tracks the physical gold prices movement. What is the expected return in the next 3 to 5 years? Wow, it's a very, very, very tough questions. Okay, I do not know sincerely, because again, right, it actually depends on a lot of factors. But again, right, I would say that if you want to buy gold, if I were want to buy gold, the main purpose is that I want to hedge, be it currency, or want to hedge my equity risk. Okay, I will not bet much on the capital appreciation, because if I want to have capital appreciations, right, I might go to buy equity. I might go and buy the oil, because the thing about this is that you got to understand one major things. At this moment, right, people are selling gold, and people are selling bond as well. Why do they do so? Because they want their money to be on the they can tahan more risk at the moment. They want riskier asset, because they believe this riskier asset, right, can give them more returns. So at this moment, right, I cannot tell you exactly what is the expected return in the next 3 to 5 years. But in long term, it should rise in prices as long as there is no market crash. If there is a market crash scenario, right, all the asset prices, including equity, commodity prices, including gold, right, will all come off, will all come down. Okay. Yes. Okay. Okay. Sure.
Not sure whether you answered all those questions.
Yeah. Okay.
Then some
okay, sure. Okay, let's answer some of the questions from Facebook as well. Okay, I got one question from the Facebook: how to buy the gold ETF. Basically, it will be listed in Bursa Malaysia soon, and then you will know the details soon, because we are going to have a lot of webinar, a lot of seminar at your places, maybe at Pahang or at KL, Penang as well. So later on, right, we will let you know about it. Okay, and I have the next question from Facebook, right? Okay, for ETF, right, is there any fixed period that the issuer will reshuffle the portfolio of underlying assets? Okay, policy that require to semi-annually review of the underlying asset. Not sure is there a such policy. Okay, it's very interesting questions because if you talk about equity, right, if you invest into KLCI index, right, you know that there will be a review committee that review the holding semi-annually to put in good stocks or remove. But this gold ETF itself, right, basically they will just buy into minted gold bar. So there is no such policy that they will reshuffle the portfolio of underlying assets because they were just holding the physical gold bar. So there is no major changes of the on the underlying asset itself. Okay, when the mandate telling you that they are going to buy into physical gold bar, they will just do it. Okay. I have a question. When is Bursa Malaysia going to launch the gold ETF? I'm not quite sure yet, but I hear it's very, very, very soon. Okay. Okay. Secondly, I have one question from Derek Uy. Can we short gold ETF or other ETF? The answer is yes. If you want to short gold ETF, the answer is yes, but you need to go into other exchanges. If you want to short gold ETF, you want to short S&P 500, if you want to short USD, you want to short Euro dollar, you want to short oil, you want to short all the banking stock in the world, there is a particular index ETF in other exchanges, but it's not in Bursa Malaysia at the moment. Okay. Yeah. Okay. Mention something improving in ETFs. Okay. Okay. Let's go back to answer the question posted by others as well. Okay, I have a question by Henry saying that what's the key difference between investing in gold ETF and via the bank paper gold? Okay, basically I have answered to that earlier. Basically, right, just to show you. Okay, the main difference is that if you want to invest into gold, participating into the prices movement only, you cannot repeat physical gold. Okay, whereas if you buy into bank gold, right, you are buying into paper certificate gold first. But if you want to withdraw in your gold bar and store in your safe deposit box in your house, you are able to do so. You just need to pay a fees as a conversion fees for it. Okay, they were going to charge you for it. But the main difference is that when the bank quote you the prices, right, they are going to quote you in ringgit Malaysia. Okay, when you buy, you are buying in ringgit Malaysia. When you sell, it's in ringgit Malaysia. You cannot use your existing USD to buy. Okay, and secondly, you need to understand if you buy now and sell now immediately, right, there is a price difference, and the price difference is ringgit Malaysia $5.2. That means if you buy and sell now immediately, you're going to lose out on the spread of 2.9%. So this is the cost that you need to pay. Whereas gold ETF, right, the spread will be quite tight. Okay, so this is the main difference. So you need to evaluate whether it's best for you to buy into gold ETF or buy into the bank paper gold. Okay, I have the next question is there Malaysia ETF really worthy to invest in? Currently, we have 8 ETF in Malaysia, but all seem to have very low liquidity, which is quite different compared to US ETF. Yes, it's very low liquidity. But again, right, this is why the market needs your support as well. Market maker will put in order, but also need your support to put it, you sincerely want to invest into it so they can match your order. Secondly, what I want to say is that if you seriously want to buy 500,000 quantity or $1 million quantity, right, you do not go into the exchange and buy it. You just call up the participating dealer because they can quote you a better pricing. So if you want to buy a large sum, right, just call the participating dealer. Normally they will be the broking houses. Okay, so I would say that the liquidity, right, is actually as good as the underlying asset. Okay. Okay, let's continue to answer more questions. Share market crash. Okay, I have a question here saying that if the share market crash, will the gold prices go up? And where should we invest our money into? Okay, usually the norm is that if the share market crash, right, the gold price usually will go up. Okay, because people don't want riskier assets. They want some asset can hedge the equity risk or can hedge the inflation, right? They will go for gold. So this is why during the market crash, right, gold prices will usually go up. But again, right, what I want to stress here is that gold prices up or down is determined by a lot of factors. Like what I just say, demand and supply as well. So you need to look at a lot of things. And in terms of market crash, right, where should you put your money into? Depend on what kind of market crash scenario lah. Will it be long term or short term? Okay, because all I want to say here is that you maybe can invest into ETF, passively managed ETF like KLCI index, right? That is trying to mimic the 30 stock performance by diversifying your risk. So in terms of market crash, right, maybe it's best to diversify your risk by invest into a bucket of stocks as well. Okay, for Malaysian, can I register an account with iShare to invest into ETF? I don't quite get your question. iShare is a fund house. Okay. Sorry, I don't quite get your answer on that. Okay, question of that. Okay. Okay, have next question here. How fund manager manage gold ETF? You can't like keep trading physical gold, right? Oh, okay. Basically, gold ETF are all invested in physical gold bar. Sometimes they set up a fund mandate saying that the AUM, the asset under management, the money that I receive, the fund that I receive, 90% of them, right, need to be invested into physical gold bar. Okay, and 10% maybe is in cash. Okay, so basically, right, the asset under management, right, is usually backed by physical gold, and they are keeping the physical gold bar parked somewhere. Okay. Okay, will there be a video recording for us to watch again later? I believe so, because they are doing it in Facebook Live. Maybe you can go to Bursa Marketplace Facebook later, and then you can see the whole video again. Okay, next, how close should we monitor the gold? More time required compared to shares? Okay, how closely should we monitor the gold prices movement? Okay, I would say that it depends on what type of trader you are, be it a short-term investor, short-term trader or long-term investor, because the things that you look into it will be quite different. Okay, so it actually depend on your frequency of tradings and whatsoever as well. But usually the gold prices movement, right, is not that volatile compared to equity or oil prices itself. So I would say that it's more used as a long-term investment instruments. Okay. Okay, okay, how to use Fibonacci extension and when to use the Fibonacci retracement correctly? Okay, maybe you can request for Bursa Malaysia for an entire advanced Fibonacci course if you would like to have that kind of course in your places. Okay, because it's a whole day course or 2-day course to talk about it. Okay, I have the next question. Bank paper gold is backed up by real gold or not, depend on the bank. But I would say that usually it's backed by real gold, by physical gold, minted gold. Okay. If you want, right, maybe it's best for the bank to answer to you rather than me. Okay. But I would say that they also need to have a gold reserve as well, because some clients, right, may go to the bank and say that, okay, I want to withdraw this gold. So they need to have the gold bar ready for them for the withdrawal request. Okay, and let's answer more questions from the chat box as well. Okay, if the physical gold bar will be held under ETF, what is the cost of storing the gold bar? Wouldn't I have a negative carry? No, you will not have a negative carry. Okay, so basically the thing about having this you need to understand in a way that depend on the gold ETF itself, right? Usually the storage fee is all part of the annual management fees. So you can see there is an expense ratio previously when I show you there is a 0.4%. So this 0.4% is annually. So as long as you hold on to the gold ETF, right, you need to take off 0.4% already. Okay, as part of your cost. That means that if you're holding to the gold ETF, right, 1 year later, it need to go up by more than 0.4%, because this is the cost as an expense ratio. Okay, and I would say that it's still best to have it, because you have to understand that it's not so safe if you seriously hold gold bar at your home deposit box. Bank paper gold is backed up by real gold. Okay, again, I have a question here. Bank paper gold is backed up by real gold or not? Usually it is. Okay, and let's go back to the Q&A sections. If physical gold bar, what is the cost of storing the gold bar? If physical gold bar will be how much? Okay, I have a question here. Can we have a repeat of the seminar? Yes, we certainly will have a couple of webinar or even seminar, maybe at Penang or Pahang or other places as well. You can put in a request on that. But basically, I think in the beginning of November, right, we will have a webinar coming on as well. So no, in December. So you may look out in the Busan Marketplace website and take a look and subscribe to it. Okay. And just to let you know that something is brewing in the ETF space in Busan, Malaysia. So watch out for it. Okay. So thank you everyone for coming to today's seminar. I wish all of you happy tradings. And that will be all. I will see you again. Thank you very much. Okay. Okay, I stopped sharing already.